August 6, 2024 marked a turbulent day for the Nikkei 225, Japan's leading stock market index. It experienced a significant drop, signaling a wave of unease rippling through the global financial system. This decline was not an isolated event. It was triggered by the actions of American investors, highlighting the interconnectedness of the world's economies. The Nikkei's fall serves as a stark reminder that events in one corner of the globe can reverberate across financial markets worldwide. The day began with growing anxieties about the US economy. Investors were particularly worried about rising inflation and the potential for a recession. The US Federal Reserve had been steadily increasing interest rates to combat inflation, but concerns lingered about whether these measures would be enough. Adding to the uncertainty was the ongoing trade war between the US and China, which threatened to further destabilize the global economy. As doubts about the US economy mounted, American investors began to seek safer havens for their money. One particular asset stood out: the Japanese yen. The yen has long been considered a safe haven currency, particularly during times of global economic turmoil. The US economic outlook was not encouraging. Inflation remained stubbornly high. The Federal Reserve's interest rate hikes seemed to have a limited effect. Investors grew increasingly concerned about a potential recession. This uncertainty fueled a flight to safety. American investors began pulling money out of US markets, looking for more stable ground. The Japanese yen emerged as a preferred destination for this capital flight. The yen has a reputation for holding its value during times of global uncertainty. This makes it attractive to investors seeking to protect their assets from market volatility. The increased demand for yen from American investors put upward pressure on its value. This surge in demand for the yen did not go unnoticed. The Japanese government, in collaboration with the Bank of Japan, decided to intervene. They were concerned about the rapid appreciation of their currency. Why is the Japanese yen considered a safe haven? Several factors contribute to its reputation. First, Japan has a large and stable economy. It is the world's third largest economy, after the United States and China. This stability provides a degree of confidence for investors during uncertain times. Second, Japan has a current account surplus. This means that it exports more goods and services than it imports. This surplus indicates that Japan is a net lender to the world, which further strengthens its financial position. Investors view this as a sign of economic strength and resilience. Third, Japan has a long history of low inflation. This makes the yen more attractive than currencies from the countries experiencing high inflation. Inflation erodes the purchasing power of a currency over time. Investors are drawn to the yen's stability as a store of value. Section 4. Japan steps in, a bid to steady the ship. The Japanese authorities were wary of the yen's rapid rise. A stronger yen can have negative consequences for the Japanese economy, particularly for its export-oriented businesses. To counter the yen's appreciation, the Japanese government and the Bank of Japan intervened in the foreign exchange market. Their primary tool for intervention was selling yen and buying US dollars. This action aimed to increase the supply of yen in the market, which would theoretically lower its value. The intervention was a clear signal from Japanese authorities that they were closely monitoring the situation. They were prepared to take measures to prevent excessive volatility in the currency markets. The intervention had a temporary calming effect on the market. However, it did little to address the underlying concerns about the global economy. The US economic outlook remained uncertain. This meant that the pressure on the yen was likely to persist. Section 5. Exporting giants. Feel the pinch of a strong yen. Japanese exporters like Toyota, Sony, and Panasonic found themselves caught in the crosshairs of this currency turmoil. A stronger yen makes their products more expensive for overseas buyers. This can hurt their sales and profitability. These companies rely heavily on exports for their revenue. The strong yen posed a significant challenge to their business models. Toyota, for example, saw its profits squeezed as the yen appreciated. The automaker had to contend with higher production costs in Japan while facing intense competition in key markets like the United States. Sony, known for its electronics and gaming consoles, also felt the impact. Their products became less price competitive in global markets, Panasonic, a major player in consumer electronics and home appliances, faced similar challenges. The company had to navigate a difficult balance between maintaining profit margins and remaining competitive in price-sensitive markets. The strong yen added an additional layer of complexity to their operations. Section 6, from Wall Street to Tokyo, a chain reaction unfolds. The chain reaction started with economic worries in the United States. These worries fueled a flight to safety among American investors. They sought refuge in the perceived stability of the Japanese yen. The surge in demand for the yen caused it to appreciate rapidly. This appreciation in turn put pressure on Japanese exporters. The Nikkei 225, reflecting the overall health of the Japanese economy, dropped sharply. This decline was a direct consequence of the global currency movements and economic anxieties. It highlighted the interconnected nature of financial markets. What began as concerns about the US economy quickly spread across the Pacific, impacting Japan's stock market. The Nikkei's plunge was not merely a domestic issue, it served as a wake-up call for investors worldwide. It underscored the fact that economic tremors in one part of the world can send shockwaves across the globe. Section 7. Global Markets, a Symphony of Interconnected Risks. The events of August 6, 2024, provide a powerful lesson about the interconnectedness of global financial markets. Decisions made by investors in the United States can have far-reaching consequences, impacting markets and economies halfway around the world. The flight to safety into the Japanese yen, triggered by US economic concerns, had a ripple effect across financial markets. This interconnectedness is a defining characteristic of the modern global economy. Capital flows freely across borders, seeking out the best returns and the safest havens. Understanding these interconnected risks is crucial for investors and policymakers alike. Navigating the complexities of the global financial system requires a keen awareness of how events in one market can cascade into others. The Nikkei's August slump serves as a stark reminder that we live in an interconnected world. Economic events, whether positive or negative, do not respect national borders. Recognizing this interdependence is essential for making informed investment decisions and for developing sound economic